Bueno, pues en los próximos segundos hacemos una mirada más internacional sobre cómo está ahora mismo la inflación, cómo está el sector bancario, temporada de resultados y también, pues bueno, algunas recomendaciones de cara a los inversores para los próximos meses. Hablamos con Brian O'Reilly, que es responsable de estrategia de mercado de Mediolanum International Funds Limited. Brian, thank you so much for being in Negocios Televisión. Good afternoon.
You're welcome and good afternoon.
Brian, inflation numbers are falling, but central banks continue to raise interest rates, both the ECB and the Federal Reserve. What are your thoughts on inflation and on the direction of interest rates?
Well, the good news is inflation is most definitely easing. And I'm sure for a lot of households it may not feel like it now. Inflation is still running at levels we haven't seen since the 1980s, but I think the trajectory is very clear. Even today we had some inflation data out of Europe. German inflation is now below 7%. It was as high as 12% in the third quarter of last year. In fact, Spanish inflation is leading the pack, down below 4% at 3.8%. And again, it was as high as 11% not so long ago. At a regional level, what does that translate into? Well, from a US perspective, inflation is 5%. And in the Eurozone, it's below 7%. So I would say that central banks haven't yet won the war on inflation, with inflation remaining still at quite high levels, but they're certainly winning the battle. So I guess the question for all of us is, why does that matter? Well, ultimately, the faster that inflation falls, the quicker central banks will stop raising interest rates. And we are beginning to see some signs that higher interest rates are taking its toll on households. Indeed, some of the dislocation with the bank failures, particularly in the US over the last month, pay homage to that. But we think if inflation can continue to move on its current trajectory, central banks will have more confidence in the second half of this year to at least pause their interest rate hiking cycle, and that will, I think, put the global economy on a much steadier footing to ensure that we don't endure a long-lasting recession as a result of these rate hikes.
Brian, we have seen a number of bank failures these weeks, Silicon Valley Bank, Credit Suisse and First Republic now under pressure with outflows. What is your assessment on the health of the banking sector?
Yeah, that really is the key question that is doing the rounds among institutional investors. So, are these once-off events due to the very fast adjustment in interest rates, or are we looking at the start of something that resembles a repeat of the global financial crisis in 2008? My view is that while as worrying as these bank failures have been, and you mentioned First Republic again this week, this is not a repeat of the global financial crisis. And I'd point to three main reasons. One, banks are much better capitalized today. Secondly, banks are much better regulated, continuous stress tests since the global financial crisis to ensure that banks have adequate capital buffers. And thirdly, banks are very profitable. In fact, certainly in the European banking sector, with interest rates pretty much set at zero for the last decade, banks found it very difficult to earn any profits. Yet today, we see some really positive results from the European banking sector. So again, their capital base is much better. I would also differentiate between what's happening in the US to the banking sector here in Europe. The banking sector in the US tends to be much more fragmented. There are an awful lot more regional banks with specific exposure to the likes of commercial real estate and the office space, which we know is under pressure post-COVID. Whereas in Europe, we have a much more consolidated banking sector, much larger, better capitalized banks, even in Spain, the likes of Santander, Caixa, BBVA as examples. So we think, even if there are further bank issues, they likely emanate in the US and the European banking sectors in a much better health to deal with some of these issues.
Brian, earnings season is currently underway for the first quarter. How are companies performing?
Yeah, it's been a mixed picture so far. We're just over 1/3 of the way through. If we look at it from a top-down macro perspective, earnings are expected to be 6% lower than they were last year. Probably a little bit more worrying that this will be the 7th consecutive quarter that margins are declining. But it's really a fragmented market. On the positive side, we've seen really stellar results from the banking sector, particularly in the US. Technology over the last week, Microsoft earlier on in the week, Meta or Facebook. Yesterday, stellar results, share prices up over 10%. And even, secular trends like renewable, I point to Iberdrola, earnings growth up 27% year over year. So there are a lot of opportunities still in the market, albeit that, company earnings are slowing as the global economy begins to come off its sugar rush high post-COVID. But overall, 78% of companies are beating estimates. So it's not a catastrophe by any stretch of the imagination.
What is your key advice for investors for the remainder of the year, Brian?
I think really, the case of whether you want to be bullish or bearish depends on your view and belief for how quickly inflation will fall. From what we see, inflation is following a very similar trajectory as we saw with the first oil shock in the 1970s. So we expect inflation to continue to decline over the course of this year. And that is typically a good environment for investors. Central banks can ease up on the rate tightening cycle. It should give households and consumers more confidence to spend. So all in all, it tends to be a pretty good environment for investors. For longer term investors, of course, we will have some ups and downs in the market as we do every year. But for longer term investors, certainly our advice would be to use any short term pullbacks that we may see over the coming quarters as a buying opportunity. And even in the context of kind of the levels of returns we're expecting over the medium term, equities we know will deliver the best returns, say, over the next decade. But even bonds today, which were almost uninvestable for a very long time, yielding 3, 4, 5% in relatively safe parts of the market, that will go a long way to help investors, meet their long-term return goals and expectations.
Brian O'Reilly, thank you so much for being in Negocios Televisión. It's a pleasure to speak to you.
You're welcome. Have a good weekend.